Okay, and I do this when I'm trading because that way I don't get stressed out or anything. You know what I mean? Guys, one more video in English. I am not a financial advisor. Follow me if you're new, subscribe, whatever that YouTuber stuff, but I'm not a YouTuber. We're here for the charts, and so am I. You guys are here for the charts, I'm here for the charts. We're going to do it. Simplify our trading, okay? I have a few topics I want to get out there so that your trading becomes more simple. Why are you sometimes not making the right decision at the right time? It's probably because you're lost in the market. You don't know where it's supposed to be going, right? Because it's all like that. But let's make it quick and simple. I'm here at the 4-hour time frame. This is gold, and I have these basically key factors or variables that my decision making system has to take into account. Okay, I'm gonna be writing them down, and basically we're gonna be looking for them based on market conditions. So I'm gonna have four, these are the four topics. These are the four factors, elements, whatever you want to call them, but there are four things, conditions you want to see in the market before you trade. Okay, and I like everything nice and neat, so bear with me. Like that. So we're basically overlapping these because we want to find a moment in the market where and when these elements are lined up. And I like to say that planets get aligned. The planets are aligned because these are like planets, basically. So here we are. These are our four topics that we want to see in the market. And the middle point is basically a high probability trade. Okay, that's it. It's no more than that. And the four topics, we're going to label them in different color because we're going to draw on the charts with these different colors so that you can appreciate them better and fully understand what I'm trying to explain here. Okay, so we're gonna have these like that. This one seems okay. Let's make it more purple. I guess you could. Yeah, okay, you understand. Okay, and so these are imbalances or higher time frames. So higher time frame, liquidity areas or areas of interest. Okay, and then here we're going to have imbalance areas, and we're going to have the factor of time. So what time is it? Factor of time, time of day, hour. What time is it, basically? And then we're gonna have here candlesticks. So the anatomy of candlesticks. Okay, these are our main topics. These are things that I'm going to be looking for and try to align them. Okay, try to line them up, and if they're overlapping each other, then I take a trade. Okay, and you're gonna see how that plays out live on the market. So here we are, 4-hour time frame. We're gonna start from left up to the right and then down. So we're going to start with this blue area of higher time frames. By the way, I'm going to change my cursor so that you guys can see it better where I'm pointing. Here it is, cursor. I'm going to make it a line, so there it is, right where these two lines meet. That's where I'm pointing. Okay, so higher time frame areas of liquidity. What is liquidity? How do I identify an area of liquidity? Okay, let's explain it simple. If someone is buying in a market like this, what are you supposed to be doing if you buy? Where are you putting your stop loss in regards to the market? So textbooks say, many YouTube videos say, And that's how it goes. You put your stop loss below a recent low or above a recent high. It's the rule of thumb. It's basically what most people do. Obviously, nobody or almost nobody is going to place their stop loss at like a previous week's low, for example. That's way too much unless they have a lot of money and their strategy is a long-term strategy that requires a lot of margin of error and a lot of stop loss, or I should say a lot of pips as their stop loss. But 80% of traders are retail. They're placing their stop in obvious areas. Like if we look at the chart, all these lows here, these wicks, when the market was anywhere up over here, people were placing their stop loss just below those wicks because it's a safe spot, And so it goes when the market is falling and people are selling. So if they sell anywhere around here, they're going to place their stop loss just above these highs. And in this case, when the market started falling over here, people who were entering short, they're placing their stop loss right around those wicks, maybe even on top of those. So those are the areas of liquidity. Wherever you think there are stop loss orders or stop orders that represent a loss, or buy stops if nobody's entered the market, and respectively short stops. But any stop order is protecting an existing trade or interest to trade. That's why I call those interest areas or liquidity areas. They're liquidity whenever there is already a trade existing and people are placing their stop loss. So that represents a loss. So it's money there to be taken. And then interest, it represents, or it's more interpreted as a order to buy or to sell at that price. And so it is eventually an interest area. Okay, so what I'm going to do with that first topic is market in my 4-hour and daily time frame, the higher time frames. Some people are, again, they're not gonna be trading the daily time frame to hedge a position, or if you're a swing trader, you'll probably use the weekly, daily, and 4-hour time frames, and your lower time frame is going to probably be 1 hour, 30-minute time frame. But many of us, we're day traders, right? We like to go in and out of the market, take a trade within a few minutes, maybe hours, and that's it. We're calling it a day. So our higher time frames are going to be a day time frame tops, and the 4-hour, 1 hour are going to be your highest time frames to analyze. Because if you think about it, if you draw this area of liquidity above these highs, and you zoom into the 1 minute, 5 minute time frame, you're not gonna even see that rectangle. So but that's the homework. That's what you should be doing. So we're gonna draw those interest areas in blue because that's our color blue. So I'm going to draw this. I'm gonna leave that rectangle there for the future. But right now, I'm just going to make it, the evident areas of resistance or liquidity and supports, or, these obvious points in which the market has shown rejection, and many stop orders are right here. As many of you may know, if the market closes below the support, it's likely for it to trade lower. So someone who hasn't entered a trade here and they don't want to miss that fall, they'll place a short stop right there, maybe above these wicks or just below it. And anyone who bought here, well, if they're holding and they haven't secured any profits, or if they have and they want to let some trades run, those stop orders protecting that long position, which equal to short stop orders, they're going to be just below this wick and maybe below their entry level right over here. So that's how these liquidity areas start to accumulate orders, and eventually algorithms push market towards those areas of interest. Okay, so I'm marking those. Obviously I have to mark this important low here, and what I'm doing here is I'm grabbing the end of the bodies and the wick, because all that area is going to be interesting, and I'm going to leave it there because, again, if I zoom in to the time frames where we're going to be looking for our entries, which is 1 minute, 5 minute, I'm not going to see this. So that's it. And so also in this time frame, now we're going to jump to our second topic, planet element, variable, whatever, that we want to spot, which are imbalance areas. So imbalance, if you don't know, you have to look at three candles. So say it's 1, 2, and then maybe this one is bearish, like this. And the wicks of these candles here are something like this. And this one maybe like this. Okay, so if the market continues rising here and it doesn't fill this empty space that we see between these two wicks, that's an imbalance. So you want to spot those areas, because it's, look, I don't want to say this is 100% precise, but in at least 50% or more, it will respect these. So the market, when it opens here, so this candle here at the bottom started trading up. This one traded quite, violently, and it left a gap between these two candles. The next candle is likely to trade into that empty space and then reject quickly and continue higher. So that's what you want to spot. See, this wick is going to come anywhere like that. You could go back, look at this and test it. You can, it's there. So we want to mark those imbalance areas in these higher time frames, and you'll see how the market eventually overlaps. You can overlap these things. Hold on, so this is orange. We're going to change it to orange. Okay. What other areas do we see? So right here, you see this one with that empty space, and I think that might be the target of next week, but we'll see what happens. And obviously you could be pointing out to this one, right? But it's one where the market has been bouncing into and out of. So I'm going to zoom in and point out this wick. So this candle's low. Notice how this strong bearish candle doesn't have a wick or candles next to it on its left side, and on the right side, this next candle didn't trade up to kind of retest where these candles finished. So that empty space is what we call an imbalance, and eventually the market makes pullback movements toward and into these areas and bounce from them, or they behave a certain way to maybe continue on that direction. So these are the areas you want to trade. I want to point something out. Do you see how these two overlap? Do you see how this blue rectangle and this orange rectangle, they overlap? That's where these two things come together and they overlap, and so those two planets are aligned. If I move my mouse here, my cursor and we look down at the time and day of the week, and this is the 4-hour time frame. This specific candle was Thursday at 10 p.m. is not a valid hour to trade. Well, it's not like it's not valid. It's just there isn't much volatility. This is New York. 10 p.m. New York is when Asia's starting to open. So ideally you want to trade the New York session or London session. And so for me, the factor time is between 8 a.m. and 11 a.m. New York Eastern time. So if at that time, in that window of time, those two things are overlapping each other, we've got three planets aligned. We've got the factor time, meaning that between 8 and 11, there's an imbalance or prices within an imbalance that is hitting a liquidity area. You see that? And in there, I'm going to study the candles. We're going to jump in these candles in a little bit. But going back into this, so I'm going to erase that big orange imbalance because it's going to distract us. I want to show you a specific example here. Now we go to the 1 hour. Okay, this is the 4 hour. I'm going to zoom out again. So as you can see, the high, the low, this high that made sense with these lows over here. I don't really have to mention the past. I'm just that's an obvious high. And then we've got these lows that the market has been fighting with, and I like to extend them out in the past to see, because it's interesting to see how these areas, they behave as pivot areas. So if price breaks lower, then it's going to trade lower to the next low. If it respects it, it might go back to the previous highs and so on. So that being said, if this if this low holds, right? So wait. Wow. If this low here holds, then it's likely for it to go back into this high because it's been that range as a consolidation area. Okay, 1 hour time frame. What are we going to do in the 1 hour time frame? The same thing. Let's see what happens here in the 1 hour time frame. So obviously, as we get closer and closer, the past is more irrelevant. So now within this range, so this was the 4 hour range all the way up here and all the way down here, right? But now, in regards to this shorter term consolidation area, what's the range right here, this blue area, these blue external ranges, externals like high and lows. So within that range, we know that's an area of interest. We know there's liquidity there. Now, between that range, what imbalances are there? What are the liquidity areas of interest? So obviously all of this up here, we start again from the first, variable, which is the liquidity. So above those highs, there's a lot of stop orders, and certainly maybe we'll see the even lower time frames this low. But I'm obviously I don't have to mark again. I know that's where the market has a liquidity area, and then we go to the imbalance areas. So the obvious one that I want to point out is right here. So you see that between that wick and that other wick, we've got that imbalance. So we're going to mark it with our imbalance color. And while I'm at this, let me just save it as an imbalance. Do I have an imbalance? I do have an imbalance. Oh, but it says text imbalance. No, that's not the imbalance I wanted. Let's go back. Okay, I'll do that later. If I extend this, notice how if I ignore what happened after this point, just by seeing the market bounce from that point to the downside, right? And now kind of trading up and down just before it, I know that is an overlapping area between an interest area and an imbalance area. Okay, as soon as I see that the market trades down and it rejects this balance area, it creates liquidity because people are entering shorts, or the market is taking short positions, and naturally there's going to be stop orders put there anywhere just above that wick. Okay, so if we continue looking into the future, we see that the market trades just above it and comes back down. So that's where the manipulation took place, and that is where the candles, we're going to study we're going to be able to spot those clues. And I want to point something out now. Look at the time and look at the day. If I place the mouse just on that wick, on the candle that went above that previous high, it is Wednesday, which is the most important day of the week, because it's usually and mostly the case is the day in which the week expands. Okay, it's the day in which the week will make the full body of the candle, whether it's bullish or bearish. And many economic events and reports come out on Wednesdays, so there's a lot of volatility on Wednesdays and a lot of decision in the markets. So, and then lastly, it's 10 o'clock a.m. Eastern Time, New York, which is the best time for trading. New York and London are open. The stock exchange, New York Stock Exchange, opens trading. Institutions, banks, hedge funds, they're positioning themselves. They're taking orders, closing orders, and so on. So the fact that the market traded above these highs into this imbalance area of 1 hour time frame, above those, I already said that, but above the interest area, and then by 11 it's already back inside the range. That was a liquidity grab, there was a manipulation we can identify, and you could have entered a short position there. Okay. We continue again one more time, and one last time before that stronger, longer fall. And that's what's been happening lately in gold. Let's go into lower time frames to study the manipulations that we can clearly spot. I'm going to point out this moment right here. It was our 8 a.m. to 9 a.m. on a Tuesday. And then we're going to see this right here, which is Wednesday, 8 a.m. Wednesday. And then we're going to see this 10 a.m. to 11 a.m. on a Wednesday. The same day, we had two trading opportunities, and you'll see how beautiful the market and how simple the market can show you what it's doing based on where it is at the current time. It is where it is. Okay, so I'm here in the 5-minute time frame. We have these drawings across. We will not erase them because those are our areas of interest. Whenever we see price getting near those drawings that we have, those rectangles, those different colors, shades area, that's where we're going to get our hands in, right in our mouse, or whatever your hotkey is to buy and sell. That you want to position yourself, you want to get ready, because you want to look in the 5-minute and 1-minute time frame for market structures, wicks, rejection candles, decision candles, right? So how are we going to do this? The same way we're studying the higher time frames. We're going to see price breaking above highs and lows. In this case, market is violently and with a lot of decision trading above these highs. It's eating up all the buy stops. It's inducing a lot of buyers, and people are on this wave into this imbalance area that we know. We mark this in the 1 hour time frame imbalance. Okay. Sorry. So we have this longer term area, imbalance area. And we didn't know it was going to create this, but we do know this right here. So we mark this as our area of interest as well. We have that area of interest in blue. This was also an area of interest. So as we see market trade and close above those areas, we know it's taking liquidity from there. And so those areas then now become key support areas. Okay, so you have to extend these. You have to continue to extend these to the right as you draw them. As market leaves those footprints, you extend them, because eventually you want to see market close in the opposite direction. In this case, to the downside after it crosses them up. Okay, so here we are, 5-minute time frame. We're starting to see the market trade into this imbalance area. We go down to the 1 minute. The 1 minute, we're going to look for A shapes. It's specifically A shapes when you sell, V shapes when you buy. If you haven't seen that video, I have it somewhere. I'm going to leave a button, whatever. And by the way, if you've been here, subscribe, share, like, comment, blah, blah, blah. Okay, so here we are, 1 minute time frame. Again, leave those rectangles, leave those color shades there. They're there to help you. This yellow, these blue ones, they're there to show me and to tell me whenever the market respects those in the future, that's where you want to, get ready to trade. So I'm going to delete the circle. This was not there. This is how you would be looking at it live during this moment, right? As market closes and closes and you extend those blue rectangles, this is where you're seeing. And eventually you start seeing these candles right here. Okay, these are your first initial clues. These 1 minute strong bearish candles that are closing below the bodies of previous candles. Okay, I want to repeat myself and I want to make it very, very, very as clear as possible. Whenever you see candles that are closing above or below previous candles, that's the direction the market is showing you it's taking. It's price action. If I see, in this case, 5 consecutive candles closing bearish, and as they close, they go below the opening and closing prices of previous candles, meaning they're not respecting them as support, then that's showing bearish volume and bearish strength. Unless I see otherwise. In the future, I would have to see a big bullish candle eat up all those previous bearish candles to tell me that that was maybe just a pullback, and then that bullish candle was the continuation, for instance. Okay, so again, we go back here, we start seeing these. Okay, so when you see that, you have to start marking that point in which the market stopped, rejected, and traded down with strength. So the market went up and it fell fast. So, okay, boom, you mark that area because that's where liquidity is being created. Next 3 candles, look what happens. The market went back up the same, almost, and basically the same way it came down. So you mark that low. We mark that low. There's that low. Okay, we keep looking, we extend this high right here, we extend this low, we keep looking, again, market closing, but look where that candle made a wick and it didn't close below the previous bullish candles. The wick stopped at that high we had from that other point in the past, and the body of that bearish candle respected this one. So the body didn't close below it. It's not bigger than that bullish candle. So it respected that one. Okay? Let's keep going because this gets awesome. This gets beautiful. Look at it. We have to extend our rectangle, and now we're starting to see it touching it and trade back down into that area of interest and into almost that previous low. But now as you see this, here's a bonus for you. Psychology. Here's the psychology of trading involved, where the market has to design and generate the idea of a change in direction, and it does it by doing this exact thing. As it goes up, liquidity and orders come in this case to the downside, and so the market drops. It comes back up, and near that same high, another drop. It did it 3 times. So as human beings with reason, and we see this thing happening, well, we naturally think, okay, that's a resistance. I might as well sell and put my stop loss just above that high. And that's perfectly fine. It's valid. Yes, that's true. And so that's where the things happen. That's where things go wrong. Well, that it's true, but at the same time, you have to be patient and wait for one little thing more. And that is the manipulation. And the manipulation, you're going to see it as a very spiky up move and a very spiky down move the same. An A or a V. And that happens, and it should happen during New York between 10 or between 9:30 and 10:30. But to be more, to have a better more broad time window is between 8 and 11 a.m. Eastern New York. And notice this is the 1 minute time frame. But in the 30-second time frame, 20-second, whatever, those 2 candles, that bullish and bearish candle, you can see it literally as a A shape. It's a triangle, up and down. It eats up all those orders and it sells them right away. And in higher time frames, those are wicks. So I don't want to leave the 1 minute and show you the 5 minute, but the 5 minute, that is a bearish candle with a wick that is above this high. So that shows you market manipulated into those buy stop orders from previous sellers who are impatient and they fall for the trap that was the moment it was going to start falling. And then when it eats all those stop orders, it sells them. And that's when it falls very hard. And this is where all your signals and all your lights and all your alarms go off in your mind to execute a trade, because you've seen the market, number one, within a 1 hour imbalance area, number two, trading above and closing back inside a previous high area of interest, and then doing it between 8 and 11 a.m. New York. And one last thing is it must leave an imbalance after the manipulation in the 1 minute, 5 minute time frame, at least. Why? Because that means a lot of volume, a lot of strength in that direction. And as you know already what an imbalance is, I don't have to move my chart more for you to see it right there. It's between this bullish candle and this bearish candle. That empty space that this bearish candle leaves on its left and right, there's no wick, there's no nothing. That is where eventually the market should respect. So I'm going to mark that in another color. I'm going to mark it bright red, because that's where we should take that short if and when the market goes back into it. Okay, so that's one time it goes back into it, respects it. Another time it goes just to that point and it respects it and it collapses. You see that? So you will see this as a sell setup over and over, and you'll always see this. Always. This doesn't change. You could, just by waiting for this, live off of your trading. You don't have to complicate yourself. You don't have to overthink about it. It's that simple. The thing is that, trading is hard in terms of your decision making, the psychology behind it, the controlling the trade, managing risk. Trading is not hard because of how complicated it may be reading the market. No, it's you. It's you versus you. It's how you behave, how you handle emotions, how you make decisions. That being said, this is my recipe, and a recipe. It's not the recipe, but it's a recipe that you can trade and live with. Number one, is price in an imbalance area of a higher time frame? Number two, is it trading above highs or below lows that are key areas of interest? Number three, has it made a manipulation? Has it made an A shape or V shape? Number four, after that A shape or V shape, does it leave an imbalance showing strength on that direction or in that direction? If so, what time is it? At what time is this happening? That's your fifth planet getting aligned for you to bam, make that sell, make that buy, and forget about it. You could place your stop loss anywhere you want. You could be tight with it. You could increase your volume and be super tight with it because you know it's a high probability trade. If it goes in the opposite way, it's because you're very wrong. If it doesn't, it's because this is what's happening. And that's it. That's it. This is beautiful. This repeats itself over and over. I'm going to go very quickly so that this video doesn't last more than 40 minutes. I'm going to go very quickly over the buy scenarios and the other sell scenario. So we're going to go back. We're going to go here all the way in the future. Check it out. I don't even have to explain myself too much. This low. Look at that. Look at the V. Boom, boom. Perfect. Look at the imbalance. There it is. Imbalance. What was the imbalance? It was an orange imbalance. The low was blue. This is our interest area. Look at that. We have that V shape. Boom. After the V shape, we had a second try, and it holds these V shapes and A shapes. This is like the holy grail. This thing, it does not fail. And it has to be, again, at a key time of, because people are going to be like, oh, I'm going to go look for a V shape where it didn't work, and I'm going to comment, oh, your V shape didn't work here. Well, nobody, look, go back and study V shapes, A shapes between 8 a.m. and 11 a.m. New York Eastern Time. And if they are above a high or below a low, and I guarantee you, I can sign a paper right now, I guarantee there A shapes, V shapes, they always hold if they are at the right time, at the right place in the market, at the right price. Again, going back to the example, this is the V shape. Here's your imbalance. Look how this candle at 8:20 in the morning respects the imbalance and trades up. Where? Back into our imbalance area. Again, look at these highs right here. Market is above it. It trades down with strength, closing below these lows, leaving this imbalance that I'm going to extend it out in blue so that it makes contrasts, and it holds. It holds because after this manipulation right here, check it out, these are the highs. 1 minute time frame, again, is a 30-second, 20-second time frame that you would have to see the A, but it's right there when you see these two candles in 1 minute and then close and below. That's your entry. I keep extending this. Look where the market respects it beautifully, and you've got that setup to the downside over here. And over, you can see it again here. Check it out. That holds, that holds. Okay, even here you can see another one. Here it is, these highs, that wick, the market when it closes down below with strength, it leaves that area, it leaves those gaps, and it holds them. Okay, you see that? So that's another setup to sell, and I think that is it. Those were the three setups I wanted to show you at the perfect time. That's 8 in the morning, and that one is 10:45 in the morning, where it traded. Check it out. It's just, I'm not lying to you guys. Check it out. If we mark that previous day's high and we extend it, check it out. Check it out. Check it out. This is beautiful. Oh, this is lovely. It goes above it and it trades back down. Like, I don't have to say anything else. I'm going to drop the mic and I'm going to leave, because this is the setup. This is the behavior that you want to look for and wait for and be patient with. Okay? That being said, better your trading, make it more simple by doing this. If you like my video, subscribe, blah, blah, blah. I'm not a YouTuber. I'm certainly not a financial advisor, but I love to teach what I know. And if you like it, subscribe, blah, blah, blah. Take care. See you next time.